Welcome to another episode of Develop Your Edge. So, I hope everybody's having a superb Easter and you haven't uh, had too much chocolate with the Easter eggs today, this morning. And really, what we're going to do today, guys, so this is a macro market overview session. So the plan of action is we're going to go through just a quick scoot round the markets. That'll be in the second half. But the first half is really going to be my global macro overview. I don't think I've done one of those for a couple of months. So be nice just to go through where I'm thinking and what my thoughts are about key themes and what's going on. And crikey, isn't there a lot going on at the moment? So let's just get ready. We'll just share the screen and get and kick off as quickly as we can. So just hold on 2 seconds and we'll get going. So as always with this show, and I hope you can see these slides here, please, if you have any questions, just jump in the chat and ask me any questions if you have them. Hey, Eugene, how are you? So just ask any questions as we go through. I'll try and get to them as always, because I think it's probably quite nice to have the interaction. As always, we have to put the disclaimer up, and the advice that I'm giving here is for educational purposes only. And if you do any trading, then please, if you are at all concerned, speak to a qualified financial advisor before you're buying or selling anything. This is an educational show where we're just going to talk about the markets in general, and it is not meant for any specific purposes whatsoever for anybody. So we'll kick it off. Really, this is sort of in the developing your edge view, and I quite like to have that title these days. I think we're drifting away from Trader Cafe simply because we just don't have that many interviews these days. We're more doing teaching and educational slots. So, like I said, today is a macro market overview. What are we going to talk about? Well, there's so much happening at the moment. We're going to talk about inflation and what is going on with inflation. A few months ago, I was pretty confident pre-Ukraine that inflation was on the downswing. So we'd probably seen the peak and the growth in inflation was pretty much over. Well, that is clearly not the case these days. So we'll update on that and the reasons why that's gone on. We'll have a chat around the Ukraine situation and the supply shocks and the after effects of that. More to do, I think, with Europe than it is to do with everybody else, but we still all feel it internationally, especially with those global supply chains are out there. I want to make a quick mention about employment. Employment at the moment is very high, so unemployment is very low. And mobility of labor is actually also very low at the moment too. You know, I'm sure that if I ask for people to put their hand up and say which business are you involved in, and are you short of staff in that business, pretty much everybody around the chat session and around the people who listen to this show would say absolutely we're short of staff, right? The entire world appears to be short of staff. So we're going to have a quick look at, I wouldn't say the reasons for that, but we're going to have a quick look at that and maybe some of the implications of it and what that means. And I think this is part of the shift in globalization. So what do I mean by that? The globalization shift is one whereby for the last 15 to 20 years, there really has been a low-cost worker out there, a low-cost worker that businesses have been happy to outsource to. And I think that is changing. This is the end, or the beginning of the end, certainly, of the low-cost worker. Would you trust a cheaper supply chain partner in, let's call it Ukraine, versus a cheaper supply chain partner that it lives down, or more expensive supply chain partner that lives just down the road from you? So these days, I think we're witnessing the beginning of the end of that low-cost worker. And I probably shouldn't use Ukraine as that example because, in fact, they're a very highly educated population. I'm going to talk about what's going on in the bond market as well, too, because there's been some seismic shifts in the bond market. This is possibly the worst year for bonds that's been in the market since 1994. For those of you that have any idea what happened back then, so bonds had a huge run up in yield, so fall in price. this year is no different. We're 4 months in, and if you like, the carnage or the eroding of value in the bond markets has been pretty spectacular, and we'll have a look at some charts around that. Finally, I want to have a chat, well, not quite finally, but I want to have a chat about global trade, really, and what that means, and the whole world of sanctions and how that fits in with that. I think that there's some really big impacts in the medium term from sanctions on the global financial system. This is actually one of those crossroad moments that occurs every 30 or 40 years within the global financial community. Have we turned a particular corner? Are we at a state whereby there's a different decision that's going to be made around capital and also around the rule of law, in fact, for external capital to flow as easily as it used to? And really, this is sort of wrapped up with that whole thesis around global trade. So at the moment, everybody, when you look at the value, if you like, the number of dollars or the number of renminbi or the number of euros that's going through the trade flows, you see numbers which are very similar to last year, if not slightly higher. What you do see, though, sadly, behind the scenes with that is much lower volumes. So things are more expensive, and I think that's being reflected in the numbers these days that we're seeing. However, the volumes that are being transacted are significantly lower on last year and also on 2020 and 2019 as well too. So there's something going on, and we have to try and figure out what that means. Okay, so let's sort of keep going. Now, when we start to talk about inflation, you guys know my view. Whoa, sorry folks, I don't know what happened there. Slight technical issues. You lost me for a minute. I'm not quite sure why. Um, okay, so let's get back into this. So let's start talking about inflation. So what is inflation at the moment? Do we have too much, or do we have potentially, according to some people, too little inflation? Is inflation going to go a lot higher? So I think really for me, at the last 6 months, we've seen inflation generally being caused by the energy and the supply shocks that have gone on. Now, some of these are COVID related, some of them are related to other things as well too, which have been blamed on COVID. If you like, COVID is the big guy out there that gets blamed for pretty much everything these days. But I think what we're seeing going on is some of the shortages going on in the world in terms of the energy market and also other goods as well too. That's created the inflationary shock to the system, and it's just taking a few months or certainly 2 or 3 quarters for it to work its way through the system. And I think part of this is about the employment that we're going to cover a little bit later on. And I won't harp too much about this, but I think there's been a lack of people Okay, there's a lack of workers out there. I'm not quite sure why suddenly, but they all seem to have disappeared. I suspect some have retired. I suspect that there's been other things. There's not as many mobile workers these days, but they have to be somewhere, and I don't know where all the people have gone. We'll look at that in a few minutes. One of the key things for me is that the West needs inflation. You know, we have significant debt to GDP ratios, historically crazy, crazy levels looking back over history. There's a lot of debt in the world, and as a result of that, the West could do with a bout of inflation, because there's two ways essentially to unwind the debt situation. You either default, which is one aspect of it, or else you inflate it away, which is the other way of doing it. Now, clearly, because governments don't like defaulting, the obvious thing for them to do is to inflate it away. I don't think the West wanted inflation of 8 or 9 or 7% in Europe. But I think what they've got now is those numbers. One or two reasons why they've got there, you know, it's pretty obvious if you, and we'll talk about this in a minute, you know, if you're going to run big budget deficits and you're going to run big money supply deficits, then anybody who's done Econ 101 will know that pretty much down the line you're guaranteed inflation. I don't quite know why people thought it wasn't going to happen, but strangely, hubris of central bankers. But the West really needs that inflation. So if you think about this, if you have 5% inflation for 10 years, plus a little bit of compounding, that's 60%. You know, prices have moved about 60%. Well, if you imagine the debt to GDP ratio was sitting at 100% when you started, and you have 60% inflation, very quickly you can see that debt to GDP ratio falls to about 40% really quickly. Well, roughly round numbers. We can play with the arithmetic a little bit, but the reality is that I think that the West needs some inflation. It either needs some default or it needs some inflation to wipe out some of the so-called debt overburden that we have, right? One of the other things I think which has also come about because of this inflationary bout that we've had is there was a lot of talk about modern monetary theory. And one of the key tenets to modern monetary theory is you issue lots and lots of government bonds, you give people money, and all of a sudden you only start to worry when inflation begins to pick up. Well, I think what the economic models have proved is that when you start to do anything like modern monetary theory, then pretty much what has always happened and what the economic models predict would happen has happened, is that you get that inflation and you get it hard. So where I have an issue is the outlook for the future inflation. I believe that inflation is topping out. This may not be the high print. I've had this view for a little while, and I think it's sort of like got torpedoed a bit through the Ukrainian situation, which is, if you like, extended the inflationary bout that we've had. But my view is that inflation, there's a lot of deflationary forces in the system, and I think those deflationary forces are going to reassert themselves at some period in time. You know, do the central banks want to have this? No, they don't. Do the central banks want to have inflation? Yes, they do. They talk about 2% targets. They talk about, oh, we have to keep it within the band. And then it's, well, rather than keeping it at and around the 2%, now we have to, over the medium term, keep it at and around the 2%. Honestly, these guys need a significant bout of inflation to cure the problems that, to some extent, they've created out there, right? And again, you know, if you'd have told me 5 years ago that we would be sitting here today with 9% inflation in the US and we're still doing QE, because don't forget QE has only just stopped. 2 weeks ago, the Fed was buying 10 to 20 billion dollars of bonds a week. Unbelievably. So forget interest rate rises. They were still doing QE 2 weeks ago with inflation running at 9%. I'd have said you're completely mad. Okay, completely mad. And yet here we are. So for me, when I look at this, I'm thinking the central banks have sort of dropped the ball a little bit. Okay, if they are true inflation fighters. So I think this is actually giving us a bit of a clue about the future. Is that two things are going on. One, they're really worried about changing interest rates even by a tiny amount because they feel the economy could turn down very quickly. Or else they're not too concerned about it. And whilst they talk about being worried about inflation, secretly behind the scenes they're going, oh, thank God for that. We've got a bit of inflation. That wipes out some of the debt that we owe everybody. That puts us in a much stronger position in a few years' time. So I think we're entering a period of financial repression. Now, what do I mean by that? I mean that when you have interest rates, real interest rates, which are negative, so with 9% inflation and 2% interest rates, you have a negative 7% interest rate. Okay, that means that if you had $100 or £100 or €100 in your account at the beginning of the year, it's worth 9% less at the end of the year, and you only get 2% interest rate to make up some of the difference. So you're like 7%, roughly 7% down. Okay, so that means that your money, which was worth 100 at the beginning of the year, is now only worth 93. Well, that's a pretty steep decline, and there's a lot of people out there who are going to be suffering from this financial repression. However, it does solve the debt problem. But don't forget the demographics, right? In the old days, in the 1970s, and often people refer to the 1970s, the horrors of inflation. Well, yeah, we had a young population. Demographically, we had a very young population. Today, we have a much older population who has a lot more savings. The last thing they want is to see their savings wiped out, which is what keeps going through my mind about the fact that I don't know how long this is going to carry on before something gets done. They'll allow a little bit of it to carry on, but I think at the end of the day, who's going to win? Do the older people that have savings and who are very active politically, have more sway than the young people who there are fewer of, but are the key beneficiaries of this? Because if you have a mortgage, right, that you're paying 3% on, but your house is going up by 9% a year, roughly keeping in line with inflation, then you certainly don't care. And more importantly, if your wages are matching that, then again, you're doing much better than you were, and so you don't care. Okay, over time, you do much better. All right, then the young people are still outweighed by the older people. So who's going to solve this little demographic battle? I think there's a bit of, oh, quick, let's get some inflation in now and maybe do a bit of a reset before we get voted back again by the older people who are saying, hang on a second, but you're killing our pensions, right? So this is really important. So when we look at also the other things that are going on, so we've got the energy and the supply shocks. I don't need to go into too much detail around this, but there's been the big picture here is the ESG movement that's been going on in the world has created chronic underinvestment in old energy. What do I mean by old energy? I'm talking about oil, I'm talking to some extent gas, and certainly coal. Okay, now there's a reason why, and I don't think we need to go into that. I think most people around the table have heard of climate change, so let's just move on. But what you've got to realize is that that's going to be a bumpy journey, right? So when you develop new renewable sources of energy or you start to decarbonize, you lose some of the old energy, right? And because you might lose more than you expected, consequently, when you have a supply shock, when something goes wrong, the system is so tight that then prices rise dramatically. And we've seen that recently. The underinvestment in the oil sector is quite marked, and as you can see right now, it appears that both the Saudis and the Russians seem to have quite a significant sway in where the oil price goes to. Right, and that's been quite a significant factor driving oil prices from, if you remember, 18 months ago when they were trading in negative prices to where they are now over $100. Now, again, if you'd have said a year ago oil price was going to go to over $100, I said it was always my target, but I didn't have this in mind as the rationale to get there. However, we're where we are. So that underinvestment isn't going away anytime soon. So this is long-term bullish for the energy sector as we attempt to decarbonize the entire global economy. We'll see how that works out for everybody. And I think before we had COVID, I think the global trade generally was optimized for pretty much a perfect environment. There was nothing that was essentially going to go wrong with it. Okay, so because of that, you had very little flex in the system. And for those of you who are following what's going on in the shipping market, you know that there's a lot of constraints still. However, the bright side is coming out the other end is the Baltic Dry Index, which is often used as a benchmark for shipping prices, is starting to come down now quite aggressively and has done over the last 6 months, which is a good sign. It means things are easing. I suspect they're easing because volumes are a lot lower because of what I was talking about earlier. But we'll see. And again, hey, look, generally, what you've got to remember within all of this, right, is does it really matter for the USA? Well, the short answer is no. They're energy self-sufficient. Okay, they're such a big economy that yes, they're suffering from supply shocks, but they are still the biggest economy and the most attractive economy for outsiders in the world. So people are trying to ship to them. They will simply replace by going domestically. Okay, so in terms of who's really suffering for this, I think the Asian markets suffer, and I think the Europeans are number one on my suffering list about the energy and the supply shocks. Literally, Europe is the epicenter for a lot of these problems at the moment. And we'll talk about that with regard to the euro a bit later on. Okay, employment. This is the big question. Where have all the people gone? Everybody used to have lots of people employed in temporary and semi-permanent roles in every economy in the world. And then over the course of the last 3 years, since COVID's turned up, a lot of those people seem to have simply disappeared. So have they retired, which is possible? Are there less of them now than there were before simply because of demographics? Well, that's possible too, but the reality is there just seem to be less people around, right? Everybody's short of resources, which probably is a good sign for the global economy going forward, because there's still quite a bit of slack that can be taken up, because we need more people as they come through. I don't know how they come through. I guess every year you have more graduates. I don't know. It'll be an interesting demographic to have a look at the world demographic and see if there was a problem that occurred around 2020 to 22 for new people entering the workforce. But this is actually quite critical, right? I think what's also happened is retirees have accelerated their plans as well too. So the baby boomers have retired quicker than they were probably planning. A few of them have done very well in their pensions, and so therefore can quit earlier. And I think that's had a big impact. If you think about it, you only need 3 or 4% of that 60 to 65 age group to retire a little bit early, and suddenly you have resourcing problems. And also around this employment, so pay has risen. There is a real shift going back from the capital versus labor debate in terms of how you manage organizations, companies, and economies as well too. I think that labor is doing much better than the capital sector at the moment in terms of their percentage of total costs for a business. But also don't forget, with all of this, right, the lack of people means that longer term it shifts your inflation rate a little bit higher, because people are simply asking for more money. So some of the impacts of that, we've seen some of the impacts now hitting in the bond market. This is a 40-year rally that has taken place from about the early 80s all the way through to the 2020s in the bond market. Over 40 years of a secular decline in interest rates. I think we can probably, from here on in, call that rally over. It might not mean that today or this week or this month or this quarter or this year even, the interest rates are going to go up much more than they have done recently. But what it does mean is that they're not going to go down significantly from here. And one of the big, and I think absolutely key results from all of this, right, from this bond market carnage, is to now people are beginning to realize that bonds used to be a so-called safe haven. So when there was trouble in stocks, when there was trouble in the world, people would run to the bond markets and park their money there because they knew it was a safe asset. Well, I think this is now classified in my money as a fragile asset. So what I mean by that is fragile assets are something that, as the volatility in the market goes up, as the risk assets go down in price, as we've seen with the NASDAQ and things like that, then actually bonds are going down too. That's the definition of a fragile asset. What you're looking for with bonds is for them to be anti-fragile. That means that when everything else is throwing up, that bonds, that asset class, does well. Well, there's only one country in the world that I'm aware of, in the developed world anyway, that has a bond market that's done well this year, and that's the Chinese bond market. They're actually higher than they were last year in terms of price, so lower in terms of yield. It's looking a very, very stable market. When you're thinking about other anti-fragile assets, you would also think about some of the precious metals. You may well think of, ironically these days, about oil as an anti-fragile asset, right? So it does reasonably well when everything else does poorly. So really, what are we saying with this? We're saying that debt ratios have just got too high and it's unsustainable. Modern monetary theory was a great experiment. I think it's maybe been disproven now. You know, I have to admit, I respected it, but I wasn't a fan. It was a different form of economics. I think there's going to be a consequence of this. I think that modern monetary theory is going to be replaced by a global digital currency, the government's sponsored digital currencies, as a way of reaching past the banking system and the financial markets to give money back to people. I think they'll be doing it directly. I think modern monetary theory is going to be the early pathfinder for that. But that's a discussion for another day. And that's, I don't want to get into cryptos and digital currency right now. However, there's, I think, something in there that I think is going to be quite important. I suspect MMT is just the beginning of that. And clearly right now, this financial repression is affecting savers. If you've got inflation at 7 or 8 or 9, and then you're getting paid 2 on your interest rates, it's pretty obvious to anybody that you're losing money every single year. So what was $100 this year is going to be 95 at the end of the year, right? And you can see that, as I said earlier, the best performing bond market this year has been the Chinese bond market. So let's have a look at some of these shifts, right? Let's get to some charts because that's really what we want to do. Okay, so when we look at the charts that I'm seeing right now, this is the 30-year US Treasury bond yield. So as yields go up, prices of the Treasury bond go down, and I'll show you those in a minute. As you can see, this is almost a breakout in terms of yields. For those of you that are aware of my sentiment cycle, you can see that this was a final test of the low back in 2020, and here we are now at about 292 on the 30-year US Treasury bond. Not particularly high, plenty of room for it to go higher. There will be. We're looking at quite clearly at that 350 interest rate level as being a pretty key resistance from here on in. But in the meantime, what this really means is that you've seen that bounce off the low in yields, which then means in terms of price, you've seen the market falling in price. Let me move myself to the side of the page just for 2 seconds. Hopefully you can see this now, and you can see from that high in 2020 when bonds, this is a good example. This is a TLT, which is the 20-year US Treasury bond. So think about this in price terms. So in prices, they peaked out at $170 back in 2020. They're now at 120. That is a loss of 35% of that asset. And since 2022 has turned up, right, we have lost over 16% for that asset class. So we've seen stocks go down. We've seen other asset classes start to struggle. Well, what's actually been going on around this is the bond market, your supposed friend in a crisis, that's lost as well too. So there's no safe haven in the bond markets at the moment. Okay, it is now a definition, by definition terms, it is now a fragile asset. That means, do you want to park your money there for safety? The answer to that is no, not really. So when we think about global trade, just coming back to the last 2 points here, I think there's something structural going on here, right? So my view at the moment about those of you who trade the dollar yen will be very aware of this, but also some of the euro yen and the sterling yen and pretty much everything to do with a cross rate to the yen, including the Chinese, the renminbi yen as well too. They are actually at historic, not quite historic highs with sterling and euro. We're on our way there, but against the renminbi, it's a historic high. And there are other markets where the Japanese yen essentially has been the weakest it's ever been. So what is going on? Because again, we normally assume that with a flight to quality, the Japanese yen will be the winner. Okay, people rush to dollar yen and park their money in Japanese yen, dollar yen goes down in a crisis. Well, again, it's proven to be a fragile asset. Well, why? Why is it different this time? Well, it's different this time because of a once in a generational opportunity for Japan. They have recognized, okay, they have recognized that if they're able throughout all of this crisis to devalue or to reduce the value of the yen, that from a mercantilist perspective, it is absolutely an amazing opportunity for their economy to make inroads against the Europeans. So this is about building up more trading, more exports out of Japan into other jurisdictions, notably, clearly, your next door neighbor, which is China. And again, how do we think about this, right? So if you're the Chinese at the moment, okay, who do you really care about? Well, if I'm sitting there with my nearby partner just across the shore, in terms of my supply chain, would I go with a company who's Japanese or a company who's European? What could possibly happen? Well, and we're getting to sanctions in a minute, but if something somewhere went wrong, would the Europeans drop me as a partner? I think they would drop China as a partner in a heartbeat, whereas the Japanese, because they're next door, are far less likely to do that. So there's an opportunity here that the Japanese have seen in reducing the value of their currency. In reducing the value of their currency, what they've done is basically go for good old mercantilism, right? This is just an opportunity for them to build trade partnerships and sell more stuff. So when we're looking at this from a foreign exchange perspective, how are we thinking? Okay, the thinking here is that we've got to say maybe the short-term trend has run its course. However, there's a longer-term trend going on here. The Japanese are very clearly using the opportunity to build trading partners. That suggests to me that these currency relationships, especially the euro yen and sterling yen, have a longer-term trend higher. We are going to essentially devalue the yen against the euro, against sterling. Okay, that is my longer term view. There's two different things here, right? There's a trading view. We know it's overbought or the Japanese yen is oversold. We get that, and there's opportunities to trade in the opposite direction. But the overall long-term view is that the yen is going to continue to weaken. Okay, so just bear that in mind. It's quite an important call. Now, why are we saying all of this, right? Well, we're saying all of this because of the sanctions. So there's something else that's gone on. Okay, in my humble opinion, there's been a fundamental shift in the way in which Western capital safety has come about. For the last 100 years, we have spent 100 years developing reserve currency status. We've spent 100 years telling people you're safe wherever you are if you buy US dollars. You're safe wherever you are if you buy some sterling. You're safe wherever you are if you buy euros. Okay, now, as we can see, you're safe wherever you are, providing you're not Russian. Okay, so then the rule is what's going to happen? So the people who are out there, you could argue that people from the Middle East or people from South America are saying, well, hang on a second, if they don't like me anymore, they'll just go, well, yeah, but we're making an exception to that global capital safety rule if you're from Venezuela now, or if you're from Brazil, who knows, it could be anywhere. So if you're overseas, the whole of the global system in the last 60 years that's developed has been one whereby the developing countries have produced stuff for which they've got paid, and they've got paid in dollars, and they've then recycled those dollars back into the US economy or back into the European economies. Okay, so they have essentially developed trade surpluses which they've then exported back that money into the G7. Okay, so now we have a different situation unfolding. Why will that continue in the same way? Because up until today, up until the last 2 months, no matter who you were or what you were, it was always okay to park your money in some countries. Okay, it was always okay. There was capital safety. The rule of law that was there in Western economies was never questioned. I now see this as being questioned. Okay, so this is the big challenge that we've got going on. So then the question is, who is going to be, before we get into that, this was one of the big remarkable things that took place around the sanctions was Switzerland joined in. So for the last probably 300 years, the Swiss have been reliably neutral. It's been a place where you could go, and the banking system in Switzerland has been a place where you could go and park money if you wanted to avoid trouble with or avoid losing your money in the future, right? It was a safe place. You didn't care about return. You didn't care about the return on your capital. You cared about the return of your capital. Okay, and then now Switzerland are joining the sanctions as well too. This for me is a bit of a watershed moment, something I hope that needs to be reaffirmed later on. But for me, I'm more worried about the long-term implications for this. In the short run, right? In the short run, you may well find that what has been going on, there's two forces at work here, right? In the short run, there's a global shortage of dollars in the world. There just is, take my word for that. However, you may well see people selling their dollar assets. Okay, that's the medium term, right? The medium term is they begin to say, well, hang on a second. If these guys aren't safe with their assets in this country, then why am I believing that I'm safe? So I'll start to sell up and I'll put my money elsewhere. So where would you put your money? You would put it into precious metals. You might put it into cryptocurrencies. You may well put it into jurisdictions who otherwise you wouldn't have considered, but they're offering you a safe haven for the time being. So this is the key thing, right? Has there been a shift? Because if there's been a shift, then we have a plan for the US dollar, because the US dollar should go down because the people won't be as interested in holding dollars anymore. Will there be a shift for the euro? Has there been a lack of confidence because there's now a conflict in Europe for the first time in 70 years? And does that then impact the confidence of the euro? So where are you going to park your money and what does that mean? So there could be some trends here which we can pick up, which are going to be incredibly important going forward. Okay, so let's look at a couple of these trends, right? This is Swiss franc yen. Wow, look at this. So since October, we have gone from about 120, because I'm in the way at the moment. Hopefully you can see the chart in front of me. We've gone from about 120 up to 133. That's a pretty substantial movement in the Swiss yen. It is an uptrend, guys. It's lower left to upper right. It's an uptrend. Has it run out of steam? Is it running out of steam from a trading position point of view? When I look at this, I'm going, yeah, there could be a trade here in the other direction, but for how long? What I'm really thinking about with the trade in the other direction is, well, this is a retracement in a big uptrend. I need to be thinking about where I can buy it next. If I'm trading super short term to maybe take advantage of an overbought situation because I really want to try and get long again. Because here's the key thing, right? And I love to put this slide up every single time, right? Whatever you think is going on, you always have to look at the price, right? So finding out what's going on in the world is really not hard, okay? Knowing what's going on in the world is also eventually, when you do a little bit of research, not that hard. Knowing when to do it becomes really hard. So let's use this as let's go look at the markets and see what's going on. So here's what I'm thinking in FX. Is the bear market over in the euro? I know that right now, if you look at the chart, you go, what are you talking about, Julian? It has been going down for months, if not years now. You cannot be calling an end to the bear market. However, I'm beginning to wonder if just the facts have just run, or the market has run slightly ahead of the facts, right? I see what Lagarde says, and trust me, I go, oh my God, I'm never quite sure where my opinion about Christine Lagarde waxes and wanes. I think right now she's absolutely on point. You need to read that latest ECB announcement that she came out with, right? There's text of the speech that she gave last Thursday. It suggests to me, when you look at that, you think the Fed are a complete bunch of lunatics. All right, she seems to be understanding exactly what is going on both in the world, locally, and also what is happening to inflation. She seems to get it right now, which is the reason why they're not rushing. They're not rushing out of QE because they know if they rush out of QE right now and restrict liquidity, that's the last thing the global economy wants, let alone the European economy. Okay, so if that is the situation, okay, if that is the situation, at some point, the lack of confidence in the euro will be overturned and it will turn itself around. At the moment, you have this interest rate move that is creating the US dollar rally. For how long will this continue? And this is the big question. We'll look at the euro in a second because there's a key thing that's going on there from a momentum divergence point of view that seems bullish to me. Okay, dollar yen, end of a trend. Short term, I think we're getting close. Long to medium term, no way. For those of you that remember from my speeches of old, I always had 250 yen in mind when we eventually had to re-monetize the yen. Right, okay, I'm not even calling for that right now, but what I am saying is that it's really interesting. We're at a bit of a crucial point. This is a crossroads. 125 is a major crossroads for dollar yen. It probably will this time around start to come back from there. However, watch for the long term, because the long term, and we know, is the Japanese are keen on devaluing the currency because this is a once in a lifetime chance for them to beat the Europeans economically, and they're going to try and push that button. The third thing I've got is around euro sterling. Guys, everybody is calling Boris Johnson the worst prime minister England's ever had. You know, he's terrible. Look at his behavior. It's awful. Look at what's going on with price. The stock market is up. The currency, forget about the US dollar, the euro sterling, which is the key currency cross, because 60% of the trade in the UK goes to Europe. Okay, look at that currency cross. Where is it? It's at the lows of the last 2 years. Okay, critical point, right? It is, the sterling is strengthening. So amongst all of this negative press we're seeing out there for the politics, for the economy, and everybody calling time on the UK, what is actually going on? Well, the currency is strengthening. That for me says it all. Watch the price action. Everything's in the price, guys. Okay, so let's look at the euro. Here is the key thing for the euro for me. Hopefully you guys can see this screen. I won't get too much into it, but look, new low in price, new low momentum, new low in price here, momentum opposite direction, opposite direction. This is a bullish momentum chart. I'm looking at a daily. I don't know. I'm not quite sure what happened the last couple of days. I apologize. This is slightly out of date, but not that much. A couple of days out of date. But look at this. What I'm saying here is just be careful here. This is a bullish momentum divergence in the euro. This means that the euro could well stage a rally. Now, how many people are bullish on the euro? I think there's probably 1 or 2 people out there in the world right now who are bullish on the euro. Okay, so remember, everybody is on one side of the boat. You're looking at a bullish momentum divergence setup. You are looking at an opportunity to profit from people getting out of their short positions. Okay, so where does it go to? It goes quickly to 112, somewhere in that region. Just remember, I don't know when, I don't know how. I'm just saying that maybe there's something to be done here. Just watch the euro. If you're running short positions, just be conscious of what is happening. Okay, we never know. It's all in the price action. When we see it start to turn, think about buy signals. I've been talking about this in my broadcast group. Think about buy signals. Here's dollar yen. Yeah, look, dollar yen. It's still going. It's still going. It's almost like a straight line from 115 to 126. We know what is happening there now. Hopefully you guys have understand pretty much where I've been going in terms of the explanations around it. Okay, pretty critical stuff, right, that's happening in dollar yen at the moment. So my suggestion, my advice is watch for that bearish momentum divergence. So when the market gets overextended too much in one direction, there's a potential reversal trade here. For the time being, what's going on? Lower left to upper right, it's an uptrend. Trade it whenever you see a small retracement. Okay, so this is where you have to get clever. The difference between a trading position and an investment position, really critical. Excuse me, sorry, it's been a long day today. Okay, right, and here's euro sterling. Going back, I don't know, what are we going back? 6, 8 months, something like that, a year and a bit? Here we go, 18 months. Where's euro sterling? Strengthening. Okay, that's it, strengthening. Just remember, the UK is not a basket case. Why? If it was a basket case, the currency would be going down. Why is the currency going up? That tells you something's going on. Okay, so oil and commodity markets, what are we thinking? I have for some time, this is a slide that I put up about 8 months ago. I am talking about this is the first leg of the secular bull market. I think it was done sometime around between, I don't know, now and 6 months ago. Okay, when I'm talking about secular bull market, I'm talking about much more longer term. Okay, where do you want to park yourself to be an anti-fragile asset? Surely the energy markets has got to be a home. Yeah, prices are elevated now, we get that, and you've got to understand that. However, you know, in terms of the long term, with a lack of investment, surely the energy markets are the place, right? And the commodity markets generally are the place. Choose your commodities wisely. I love platinum, I love palladium, I love the precious metals. I love copper, right? Copper is the decarbonization commodity of choice. Okay, I don't think you can invest too much in lithium or uranium. You know, you can invest in those things, but they're pretty illiquid and they're going to go crazy with crazy volatility. But just bear in mind, right? I think there's something going on here with commodities. The demand supply balance over the medium term for me is still positive for prices. So we're going to have volatility because, well, we're trading commodity markets. Of course, we have volatility. That's what happens in commodity markets. But take the advantage of sell-offs to acquire more positions. I think the secular bull market is still underway. So let's look. This is a weekly chart of oil. Does that look like a bear market to you? Maybe we take out 90 or 88, something like that. Maybe we might start to reverse this down to the nearest support. Where's the nearest support? 82, 60? Are we going to go to 60? Even if we went to 60, the bull market's still intact. That's crazy, isn't it? Right, where have we been up to? 130. We're talking about this market can halve and it still looks okay. Crazy. This is what volatility does for you, right? So there's still a lot of opportunities in the oil market to trade it from both sides, but in the medium term, long is your friend. Right. This is the daily chart of WTI. You can see we filled in the gap there. For those of you that don't follow the normal pit session, if you like, so for WTI, which is the US trading time, there was a gap down at 93. Well, hell, we went to that last week, we went down, we touched it twice, and then we quickly reversed off it. What does that tell you? It tells you that 93 is a pretty key support level, right? So sub 93, I've got a problem with the market on the daily chart. Above 93, it looks just fine to me. There's trend lines and there's triangles, and you can talk about consolidations and all that stuff, but overall it's still a bullish pattern, right? Sub 93, maybe we have an issue, but we'll see. Where if we get down there again, we probably may not for some time. So again, talking about other anti-fragile assets, right? We need to talk about the gold market. What's been going on in gold? This is the weekly chart. Doesn't it trade just fine? There's nothing to see here. Okay, nothing to see at all. Yeah, sure. We got a bit ahead of ourselves. We all know we got a bit ahead of ourselves as the market went up to 2075 in that area, 2100 area. Yeah, of course we did. The market rallied really quickly, and gold doesn't like doing anything quickly. So then what's happened is time price has caught up, and here we are sitting at 1974. This doesn't look like a bear market to me. Okay, one of the things I want to draw your attention to, this is the guys at GAN Global, what they came up with. They said if we are following the normal pattern for precious metal stocks within the 90 and the 60-year cycles, they are seeing significant movements in both gold and silver and platinum and palladium over the course of the next 3 to 4 years. This is just the start. So guys, there's plenty more to come on those things as well too. Now, S&Ps, what do we have to do? We have to beware of the Minsky moments. This is what I wrote a few months ago, right? We have to think about where the last grain on the sand pile causes the avalanche, okay? Have we seen that? Well, if you're trading NASDAQ stocks, I think you've got a pretty good idea of what that avalanche looks like. There's plenty of examples out there with Cathy Wood or the ARK funds, and many other individual stocks have lost significant amounts of value in the course of the last 18 months and are sitting on the lows. Think, Coinbase, think Robinhood, think, let's say, go look at the ARK fund, think Zillow. There's loads, right? You guys can look through them all. This is what happens when you start to unwind a period of excess liquidity and you start to unwind it. It's not uniform. Okay, you have some sectors that do really badly, others do really well. The stock market is a dangerous place at the moment because you can lose value very, very quickly. For those of you looking at the background, my background here, you know that this is the sentiment cycle. Where are we in the sentiment cycle? I believe that we are at the overt subtle warning stage. I'm not quite sure what's happening here. For me, the stock market might well just go sideways for 6 months. Could easily go sideways, right? It could also go down. The path of least resistance for me is down to sideways. The path of most resistance for me is up. Why am I saying that? It's because interest rates are going up. Liquidity is coming down. The Fed's going to start to tighten. I don't agree with the amount of interest rate rises the market's got baked into it, and I think there's a big opportunity in some of the short ends of the interest rate curve because I think they're simply too cheap. But there's times and places for everything. Right now, not is the time to start thinking about fading interest rate rises. Okay, the Fed's barely got started. It would seem weird to try and fight that unless you're just trading it for a few days. So when you have an rising interest rate environment, at some time it catches up with stocks. For me, the key thing is the Fed has switched attention. It switched attention to fighting what it considers to be the inflation genie. I think it will get back in the bottle quite easily without the Fed doing anything. Maybe they just stopped QE and raised interest rates 1% and just did something as a token gesture. That would get it back in the bottle anyway, because inflation, to me, the inflationary forces are starting to come out of the system. It's not getting worse. Okay, however, the Fed's going to raise rates aggressively because the government has told them you've got to fight inflation because everybody out there is concerned about inflation. Well, hell, these guys created it, right? So then now they've got to solve the problem that they've created. They just got let it get completely out of hand. So with that, somebody's got to suffer. And who's going to suffer? To me, they don't seem to be as supportive of the stock market as they used to be. So for me, I think this is a sell rally time for stocks. And as a result of that, I think we're at the stage on the sentiment cycle where life is going to get very, very interesting. And again, like I said, if you look at what's going on in the bond markets, the bonds are not a home for you right now. Okay, yields are going up. That means prices are going down. You're not making any money on your bond market. Guys, that's been a massively quick scoot around. I know it's taken us about 45 minutes, and I apologize for the slight delay. A massively quick scoot around, but I hope you get the gist of what I've been saying and the key things that are going on. If any of you have any questions, then post them now. I'll give you a couple of minutes for questions. Then we're going to head off because we've got TTR starting in 5 minutes, and I have to condense everything I've just said now into 2 minutes for the for the folks in the public forum. So I hope you found this useful. If you do, please say something at the bottom of the chat, and thank you everybody wherever you are for listening to me with the conversation. And I hope you found this useful about the global market environment and what I'm thinking right now, what the key themes are, and how that's going to affect some of the markets going forward. Thank you, everybody.